Okay, thank you. Good morning, everyone. I'd like to call the meeting to order and acknowledge that we're in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Ojibwe, Innu Cree, and Dakota peoples, and the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation and Treaty 3 territory. My name is Neil Hardin. I'm chairing today's panel. With me via Zoom are Lynn Nesbitt and Linda Schultz. The assessor today is Nuwan Thudagala Munasinghe, and the administrative personnel is Phoebe Graywood. We will be hearing applications for revision of the assessment rule in accordance with the Municipal Assessment Act. The matter for which revision is requested have been described in each application and will limit discussion to those matters. The statements are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the board. The board is appointed annually by council and is independent of it and the city administration. It makes its decisions on the basis of the evidence provided at this hearing, and issues a written order to be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We'll then have the assessor's testimony followed by questions the applicant may have, then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You'll receive the board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We'll be hearing items 1 through 7 on our docket today. Ms. Graywood, please affirm the assessors and applicants' testimony.
Mr. Thudagala Munasinghe, can you state your full name?
Nuwan Thudagala Munasinghe.
Do you affirm the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you. Mr. Dupont, please state your full name.
Henry Dupont.
Do you affirm the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you.
Okay, our first property today is 2000 St. Mary's Road. So, Mr. Assessor, you can begin.
Thank you, Mr. Chair. File number 241657, roll number 08021133300, 2000 St. Mary's Road, roll year 2025, reference date April 1st, 2023, assessed value 116,051,000, number of building 5, 4-story buildings, actual build year 2014 and 2018. I have to mention here 4 of these buildings built in 2018. Number of suite 425. They have indoor parking 406 and 80 outdoor parkings. Page 2, you can see the request for income information and subject sales history. Page 3, you can see the location. It's a good location, and you can see in the aerial picture, it's like a small village.
Excuse me, I didn't get the address that we're doing now.
2000 St. Mary's Road.
Okay, thanks.
So may I continue?
Yes, go ahead.
So average monthly rent per unit, 1,820. Gross potential rent, 9,282,204. Vacancy rate, we have used 3.6. Effective gross income, 8,948,045. Expense ratio, 36.45. Sorry. And net operating income comes at 5,686,483. We have used 4.9 capitalization rate. Estimated market value comes at 116,051,000. Market value per suite 273,061. And page 5, you can see the comparables. Though all comparables support the model rent. And page 6, capitalization rate evidence. Sorry, capitalization rate. And these capitalization are model generated. And you can see the multifamily chart below. And page 7, capitalization rate evidence. Those following is a sample of actual sales that took place during the reference period. The purpose for showing these individual capitalization rate is to illustrate the accuracy of the model, substantiate the model derived capitalization rate. They are not meant to be comparable to specific to the subject property. So basically, these capitalization rates support model capitalization rate. Page 8, Municipal Assessment Act excerpt. Page 9, I add a stabilization table. Mr. Chair, I have to mention here, I just add this to compare it. So I'm not asking this this value. So appears this is like higher expense and like lower income. I believe because the property management is kind of poor. I can't exactly sure because I say so. Our average comparable rent support the our model rent. And also you can see the expenses are in higher side. So normally for these kind of near like new buildings, the expenses ratio below 40. So next page, I can show you page 10. This is 2020 market insight. Winnipeg multifamily top sales, you can see there. So when I am comparing to the these sales per unit price, the subject property has 273,061 per unit, and you can see these sales. It's all of them are over that. Sorry, no, just no. The first sale is supported that. So page 11 to 22, income and expense information. I'm not going to go by pages. So page 24, you can see the exterior picture of the complex, and 25 also exterior picture, and up to 20, page 27. And page 28, you can see the the parking, underground parking there. And page 29, interior picture. And page 30, also interior picture in the bedrooms and kitchen, so and so. So you can see the quality of the building there. So basically, this is a good quality building and also a good location. Yes, the actual don't support the model value, but I think maybe because of the poor management or poor advertising, it made that income low and higher expenses. So 2020 market insight top sales price per unit support our model rent, model assessment. So I believe this is 116 million 51,000 for fair value for the property. Thank you.
Okay, questions, Mr. DuPont?
Yes. Now you did stabilize on your page 9, a lower net income that your model asks. So would you not agree that you should be using that instead of your model?
No, because like if any property is underperforming, if we use that one, it couldn't be the market value for the property. So because of that, I wouldn't use that.
You're saying subject is underperforming?
That I believe so. That's my opinion.
Oh, okay. So you're saying the rents are not as high as yours?
Yeah. Yeah, that's right.
Now your cap rate comparables on page 7. Do you have any workups for any of those cap rates?
Because of the privacy concern, we can provide the workup, but we are under oath. So this I can say this is right and like so unfortunately we can't provide the workup for those.
It's all questions I have.
Okay, Miss Nesbitt, any questions?
Yeah, I was also curious about page 9, Mr. Assessor.
Mhm.
So the rent in your model is coming up higher than what the actual is showing.
Mhm.
And you indicated, I'm sorry, that you believe it should be higher. Like I just don't kind of understand that.
That's my point of view, because this is a kind of I can say a high quality, like big complex kind of apartment building. So we don't have like direct comparison to sales or anything. So we have the average, comparable rent. So our comparable rent support our model rent. Because of that, I believe this is kind of underperforming. So that's my point. Is that what you are like?
Yeah, I'm just trying to understand your point.
Yeah, okay.
The 2020 to 2022 rents in your table here are showing year-over-year increases. So would that suggest that it is sort of trending in the right direction for rents?
Yeah, that was actually I didn't present it on my presentation. That I noticed that one too. So that's also one of my point.
Okay. All right. Thank you very much. No further questions, Mr. Chair.
Okay, Ms. Schultz.
Just one question. On page 2, you've got the subject sale history, 2011, 2007. Was that just for land? Because the buildings you're saying didn't go up till 2014 and 18?
Yes, that's right.
Just for land. Okay, thank you. That's all my questions.
Okay, I'm going to again focus on page 9. The rents shown, the actual rents are below what the model estimates,
Mhm.
but then the vacancy is also quite low. Is it uh, because the owners have adopted a lower rent, lower vacancy model uh, for this property?
I believe so. Yeah, because like if we are comparing with the market, this is kind of lower rent. So that's what I am thinking, because this is like it has a lot of amenities, and like they have underground parking. Because of that, I believe this is kind of lower rent for them.
Okay, all right, thank you. So Mr. DuPont, you can begin your presentation.
Okay, so I think if we go with his analysis, he's got stabilized 5,462,000, and I'm stabilized slightly higher. So we're very close on NOI, and it comes to cap rate. They're at 4.9, and I'm at 5.25. And I would change my cap rate today to 5%. So my revised value, that if you want to write it down, is 110 million, sorry, 088. And the assessor's income approach, page 9, is 111,488.
I'm sorry, Mr. DuPont, which NOI are you using?
My NOI, sorry, yes, I have to go. I haven't presented that page yet, so.
Oh, okay.
It goes from my page 13.
Okay, thank you.
Okay, so I use the actual rent, 8,768,000, the market vacancy. The line 9, that's property tax recoveries, that's the rebate. So I did not show it as income, but I took it off the taxes on line 30. So after we add the parking, etc., storage. Line 13, my EGI is 9,019,000, which is slightly higher than the assessor's 8,948,000. So the rents, the assessor's rents are higher, but they don't use any parking income. So that kind of offsets each other. Expenses, my stabilized expenses, done a pretty much normal way. The repair and maintenance, line 27, we stabilize at 1,009 per suite, so it's on the low side. And the total expenses, line 31, 2,000,005 versus the assessor 3,000,002. But our NOI line 33 is 5,504,000, and the assessor before his income approach that he did was 5,686,000. And then his page 9 is 5,462,000 versus my 5,504,000. Now I show 5.25 cap rate, and so I changed that today. Instead of 104 million in value, it's 110,088,000.
Okay, is that anything more to add?
I'd like to give a cap rate report as evidence. Now the
Okay.
Yeah, I don't think I need to add anything more here. Yeah, so it's so I think now that if we have a very close NOI, the cap rate is different. We don't like to go below 5% cap rate, so 4.9 is not acceptable to us. So I'd like to present the cap rate report, which would be applicable to other properties here today.
Okay. Go ahead then. Where is cap rate reports? I'll just cap rate. Okay, go ahead and
We've changed the cap rate a little bit since the beginning. So we've added some wording from the Appraisal Institute, and we give more data on 2390 McPhillips. So the first parts of the cap rate to the the fifth paragraph, I guess. Direct capitalization is to convert a single year's income expectancy into a value indication. At the next page, no, it's page 4 is where we made the difference, what we added. So from an Appraisal Institute, basically says the basis of income producing real estate is the future income we will produce. The historical data on a property or market is relevant insofar as it helps interpret the current market applications. In essence, we use the last 3 years, whatever, but what we're coming up when we stabilize is the income of the next year for a purchaser. So we stabilize the current to say, okay, going forward, this is the first year net income you would have. Then the next part says the principle of anticipation is fundamental to the approach. And the third says the ultimate concern is the future. Current income is a good starting point, but the direction, the expected pattern of income change are critical. And that came about because the assessor was quoting the Collier's market broker's report saying that the cap rate is based on the next year's income. And so we're saying, well, that's what we're supposed to do. So they're not using the next year to stabilize, is that they're using the current year to get the next year's income. So then the market reports on page 6, it's pretty much the same as what the assessor has. So a lot of these companies are starting at 5. CBRE is a bit lower. Cushman starts at 5. Some are 4.75. We show the cost of borrowing has been going up. But we can go to the comparables on page 12. So we have the first 5 comparables are smaller properties and older, except for 100 Maryland, which is built 2017. And we have a cap rate of 5.44. It's 11 suites. This is a good comparable against the assessor using these low cap rate below 5% for small properties. The two that are most applicable today, I think most of the properties today are relatively large. There's 150 Hendon and 2390 McPhillips. So we have 5.42% on 150 Hendon, 5.59 and 2390 McPhillips. So based on those two, we should be asking for 5.25, 5.5. I was asking 5.25, and I'm dropping down to 5, so we can get closer to the assessor here. And so I will only go to Hendon is page 20. So it's all on top for 6,858 on June 2021. The 2020 income was 596,929, but they increased the rents above guideline, and the 2021 rents come to 712,182, and that's for the whole year. But it's sold in mid-year, but we're using that rent. And then the bottom of the remarks, the vendor applied for above guideline rent increase with RTB, a residential tenancies branch. The RTB orders were effective June 1st, 2021 on the possession date. In the 2021 IE, it's partial year, but the purchaser was showing the potential gross 712,182, which was 1,006 per unit. And 2022 was first full year of operation. It shows that rental income received 709,213. So they did achieve those rents. So they applied for RTB increase, I believe, right after their year end, because they have to send their statements to the RTB, and then they put up for sale, and the vendor would have been using those rents. And we have in our appendix the rent application from RTB and the actual orders it has, the dates. So we have all the data supporting that. 2390 McPhillips. I'm not going to spend too much time because we've been through this in full in the past. So we use line 3. The rents that they actually had after discount was 1,445,000. We used 1,649,000. The rents we believe was below market. The rents were only 1,339 for a brand new property. So we're using the average weight CMHC rents as of October 20 data. And that's what we use. So the assessor has very similar income approach to 2390 McPhillips on the expenses and everything else, except they use the old rents, well, the actual rents of 2019, the 1,445, we use the market rents. And the next page is what we added recently. It shows how we did it to the CMHC rents. So we have the one bedroom that has based on CMHC category age 2005 plus, and those are the rents that they show, and that comes from 1,649,880. That's what we have in our cap rate calculations. And then the last paragraph on page 22, increased rents by the purchaser. We do also show in our appendix that the purchaser advertised the rents after they bought. They had rents of $1,455 for one bedroom, $1,695 for two bedrooms, higher than CMHC rents, and that produced rents of $1,798,920. But we did not use $1,798,000. That's what the purchaser increased rents right after purchase. So we're only showing that as potential to show support as to that the rents were in fact below market because they were able to increase it to almost 1,800,000, and they were getting only 1,445,000, so they increased it by quite a bit, so 1,800,000 to it's almost 350,000. So if we put in the market rent for that, it's 5.59. That's a new property, 2015. So it'd be comparable in age to the subject today and to a lot of the properties here today. So page 24, so based on those cap rate comparables, these are the cap rates that we come to different age groups. And 2005 plus, we have 5 to 5.75. Larger properties tend to sell for a higher cap rate versus the smaller properties. It's a bit like the assessor's algorithm they have on cap rate. They give really low cap rates for small properties and higher cap rate for larger properties. We don't believe we should have that large of a swing that the assessor has. But the subject is a large property, and that would give an increase in the cap rate normally, and that's why we had used 5.25 because it was a large property. But we're changing it today to 5%. So that's my presentation on the cap rate, and that should be the same presentation for all properties here today. So I'm finished with my report and the cap rate.
Okay, thank you, Mr. Dupont. Any questions, Mr. Assessor?
I have few questions about the cap rate. So, Mr. Dupont, you use just 1 year income and expense stabilization. Is it right? For the cap rate calculation?
We stabilize 1 year, similar to what the assessor does, similar to what everybody does here for properties that come in front of the board.
For our capitalization rates, we use a 3-year stabilization. Anyway, okay. So if you don't have any data, you use like you sometimes I heard you don't use the not actual income and expense involved in calculation, and sometimes you use potential gross income for future potentials or something. So when you don't have income, is that right? I'll say this way. So if you don't have, I notice one property when you are presenting, if you don't have, that means I believe that's a 2390 McPhillips Street. You use the potential income to calculate your cap rate, is it?
Yeah, we showed the actual revenue and expense for that property, and so we stabilize based taking to actual rent and vacancy in 3 years, like the assessor does. And the only thing that we did different is that we applied market rent instead of the actual rents. And I believe the boards have used market rents. They certainly use market rents for all commercial and industrial. That's a normal way to do things. You apply market rent. And we have decision from the municipal board on some commercial where they will use market rents that are higher than actual rents when they believe it's below market. So that's what we did in this case. We use market rent because we believe is under market.
Okay, thank you. That's all my question.
Okay, Ms. Schultz, any questions?
No further questions, thank you.
Ms. Nisbet?
No, I have no questions. Thank you.
Okay, one question that pops into my mind then, the property in question, you're using, I mean, it seems to be below market rents. And yet you're arguing for McPhillips, we should be using market rents. So if you derive your cap rate using potential future rent, should you not also use that same method for deriving the rents on the property in question?
There's no evidence that the subject properties are below market. They're getting 1719 rents per suite, which is quite high. So there's no evidence indicating that it's below market. So if we were of the opinion it was below market, we would use higher rent.
Okay. All right. Thank you for that. Is Mr. Assessor, do you wish any submission?
Yeah, sure. Quick summation about cap rate. So basically, in here we are dealing with historical value, like for the assessment purposes. So because of that, what we have done for the finding capitalization rate, we use 3-year capitalization rate, 3-year income and expense, and stabilize those income and expense. Then we use the actual sales against it. So against that net operating income. So that's how we derived our capitalization rate. Basically, when I'm listening to Alter's capitalization rate calculation, it's kind of a different way. So that's what I want to point it out. Thank you.
Okay, Mr. Dupont.
Yes, so on two of our cap rates, we use different rents than the actual rents in the past. So in Hendon, we used the rents that had gone to increase approval from RTB. And that's the rents that were applicable at the time of sale and date of possession. And the purchaser would have known that. So if we came to a subject property and there was proof there was an RTB rent increase by the reference date of April 1st, 2023, both the assessor and us would be using that higher rent. So when we are aware of an increase above guideline that occurred before the valuation date, we should be using that rent and not put the blinders on and say, oh, we're not going to use that rent. We're just going to use a past rent. Same thing when we have some properties that are up for sale and you have a pro forma, they'll show the actual rents that it had, but it says we now have higher rents of so-and-so as of date of sale, then it's proper to use those higher rents. So if they went for an increase beyond the guidelines and they have higher rents shown in their pro forma that they were able to achieve, and that's what they're putting up for sale, the property with higher rents, we should use that. And in all cases, we should be using market rents. For most apartments, we use the rents from the last year, most current year. And we have now and then in the past where the ads indicates renovated and have much higher rents, and the assessors after us saying you have to use a higher rents because the ad now states higher. And in cases like that, if those rents were applicable by the reference date, then we would use that. So that's the proper way of doing it, is to use the market rents and rents known at the time. And if it's below market rents, we should use the market rents. Thank you.
Okay, thank you very much. We will move on to our next property, 1476 St. Mary's Road. I'll just open the files.
1976.
1970. Sorry, I'm down the street. 1976 St. Mary's Road. Okay, Mr. Assessor, you can begin on that property.
Thank you, Mr. Chair. 241614 is the file number. Roll number is 0808-122-6220. Address 1976 St. Mary's Road. Roll year 2025. Reference date April 1st, 2023. Assessed value 12,625,000. classification 20 residential, liability taxable, number of building 1, number of stories 4, actual build year 2020, number of suites 45, and indoor parking 31, and outdoor parking 38. Page 2, you can see the request for income information. Actually, I have to mention here, I would ask for non-compliance, but I am not going to, because what was happened, they submitted the income and expense information. I believe they didn't by online, and they didn't maybe finalize it and touch the like final button or something. Because of that, it we can see the information, but it didn't mention as the response to us or they submitted. So that's what happened was here. But I can show in my presentation in next pages. So I would like to ask from Mr. Henry to inform that thing to the owner, because if this thing happen next time, we have to ask for non-compliance. Page 3, income value summary. Average monthly rent per unit 1,785. Gross potential rent 964,051. Vacancy rate 3.6. Effective gross income 929,345. Expense rate 37.51. Net operating income comes at 580,748. We have utilized 4.6 capitalization rate. The estimated market value came at 12,625,000, and market value per suite 280,555. And page 4, you can see the rent comparable. All rent comparable supported the model rent. Page 5, capitalization rates. Those are model generated capitalization rate. You can see the multifamily capitalization rate bottom of the page. Page 6, you can see the capitalization rate evidence. These following is a sample of actual sales that took place during the reference period. The purpose of showing these individual capitalization rate is to illustrate the accuracy of the model and substantiate the model derived capitalization rate. They are not meant to be comparable specific to the subject property. The subject property is 2022 buildings. So I believe the McPhillips capitalization rate supported our model capitalization rate. Page 7, Municipal Assessment Act excerpt. Page 8, again, you are familiar with this one right now, I believe so. Winnipeg multifamily top sale transaction. If we are comparing with that information, the value per unit for the subject property is 280,555. So that one supported by these sales. And
if on this point, I'll put a caution in terms of we're not using a direct comparison approach here, so we don't know what kind of value it can take from that perspective.
So basically in here we are not direct comparison compare to it. We are like try to show you our final assessment value is in line with the market sales. So I'm not going to directly compare with it. So that means as a reconciliation, we are going to try to show you this is in a range. That's all.
Okay.
Page 8, the letter, and page 10, the information. Page 11, their information. They are saying that's a luxury apartment in page 11. Page 12, we are trying to show the pictures, interior pictures in here. It's a good quality apartment. And page 17, you can see in here they have actually in suite for most of suites. So actually, yeah, all of them, I guess. Page 11, income and expense information. So their net operating income, you can see there. Page 22, I saw because they have just 1 year income and expense information. So if we utilize that, we can get the at least built-in value for the built-in cost value for the property. So that's why I add this the permit and the stabilization table here. So based on those information, I believe this is good. This is a fair value for the property. Thank you. This is enough.
Okay. Questions, Mr. Dupont?
Yes, so the page 3, you have 4.6 cap rate, and then your income approach that you did is 4.75. So are you agreeing to increase your cap rate then?
I believe that could be a mistake. I'm double checking. Sorry. Yeah, I think it's typo. I'm sorry about that.
And I believe you said you thought it was a fair value. Did you think your value on page 22 is a fair value?
No, I believe this is the fair value is 12,625,000.
Okay, but if you did go site specific, but like you did on page 22, you would have lower net income, 477,000 versus your 580,000 that you have in your model.
Yes, that's right. But this is just if you see their income and expense information, this is incomplete. They didn't submit it. That's what I mentioned in the beginning. So I able to look at the information within our system. That's why I didn't ask for the non-compliance. They didn't like complete their income and expense. So I can't believe that's the right one because they are not submitted that one like agree with the final agreement or something. So because of, and also I have to mention this is a new apartment. They don't stabilize their income and expense yet. Sometimes they have higher expense at the beginning and lower income because of they are not advertising well and they just started to rent it out. So yeah, that's all. That's
On page 21, the potential rents that you show in the questionnaires is 856,728. And that's much lower than your model at 964. So it's about 100,000 less. So would you agree that your rents are too high?
No, because as I said, this is just a new apartment. Maybe they are discounting their rent. If we if somebody is discounting their rent, that is not the market rent. So maybe the purpose to like get more renters in, and then they able to increase the rent. Maybe that's the purpose. I'm not sure, but in my point of view, that's not their, I mean, they are not achieve the optimum rent yet.
That's all questions I have.
Okay, Ms. Nesbitt, any questions?
Mr. Assessor, you indicated that maybe they're discounting rents. Do you know that they are discounting rents?
I am actually, I don't know because they didn't submit the whole information. They just actually submit the half. Maybe I'm not sure because they didn't submit. I mean, they didn't finalize their submission, right? So in that point, I can't say this is the all information is right. So if we touch the maybe finalize button, I would say yes, but in this point, I can't say. I mean, that's their rent, or I don't have any information about the discount or anything. They didn't submit any additional rent roll or anything in the system. Normally, some apartment do, but they didn't.
Thank you very much. I have no additional questions.
Okay, Ms. Schultz, any questions?
No questions at this time.
Okay, Henry, you can begin your presentation.
Okay. Maybe just go to my page 13. So we show basically the same thing as the assessor, the 156,728. I didn't include the questionnaire in my brief, but it's in the assessor brief. So I ask that you look at the questionnaire that the assessor has. So the questionnaire showed the potential rent on the rent page, 856,728. So that's the rent. And they had the revenue and expense. They don't put any parking expense revenue. But they do show in the advertising that they're getting 120 for indoor and 60 for outdoor number of stalls. So I added parking at line 10. The questionnaires did not show that, but I think maybe it was an oversight. Anyways, I'm going higher than what the questionnaire shows for revenue. So I applied the vacancy at 3.2, and I guess I should have put 3.6 because the assessor has 3.6. So line 13, I got 892,000 NOI, the EGI versus the assessor 929. So we're lower than the assessor. And we used the expenses from the first year. Repair and maintenance is 881, so it's relatively low. And the total expense line 31 is 343 versus the assessor 348. So we're dollar-wise, we're a bit less than the assessor. So our net income is 549,000 versus the actual of 513, as shown on their statements, and versus the assessor 580. So we apply 5% cap rate versus the assessor 4.6. So we get a value of 10,992,000. And the assessor's income approach they had done on separately was 10,046,000, I believe. So it was lower than us at 4.75. So the 4.6 cap rate is way too low based on our comparables, even the assessor's comparables. If they would properly use the actual rents or market rents, they would have higher cap rates. It's 45 units, so it's not that small. The assessor tends to have a very low cap rate when it's 11 suites or so, but this is 45 suites, so their 4.6 cap rate is way too low. We don't accept anything below 5%, so we're giving it the lowest cap rate we have for that age group. So that's my value. Thank you.
Okay, any questions, Mr. Assessor?
No question.
Okay, Ms. Schultz.
No questions. Thank you.
Okay, Ms. Nesbitt.
I have no questions. Thank you.
All right, I have no questions either. Let's take a break until 5 after 10 or so, and then we'll come back and do 1777 St. Mary's Road. Okay, welcome back. We will move up the street to 1777 St. Mary's Road. So, Mr. Assessor, you can begin.
Thank you, Mr. Chair. File number 24-1384, roll number 08021277,300, 1777 St. Mary's Road, roll year 2025, reference date April 1st, 2023, assess value 12,830,000, classification 20 residential, liability taxable. Number of buildings 1, number of stories 4, actual build year 2020, number of suites 57, outdoor parking 88. Page 2, you can see a request for income and income information. They just submitted the one income and expense information because this is a new building. In page 3, you can see the values, income value summary. Average monthly rent per unit, 1,438. Gross potential rent, 983,606. Vacancy rate 3.6. Effective gross income comes at 948,196. Expense ratio 37.76. Net operating income comes at 590,157. Capitalization rate 4.6%, and estimated market value comes at 12,830,000. Market value per suite 225,087. Page 4, you can say the rent comparable. The market rent comparable supported our model rent. And page 5, capitalization rate. These capitalization rates are model generated, and you can see the multifamily capitalization rate in the bottom of the page. And page 6, capitalization rate evidence. The following is a sample of actual sales that took place during the reference period. The purpose for showing this individual capitalization rate is to illustrate the accuracy of the model and substantiate the model-derived capitalization rate. They are not meant to be the comparable specific to the subject property. I believe model cap rate supported by sale evidence 390 McPellet Street. So again, I have to mention here the purpose of showing this page 7, you can see the top multi family transaction in the Winnipeg. Purpose of showing this to show that our assessed value is in line with the market value. Also, I can say in other word, in line with the sales. So the subject property, the price per unit is 225,087, and that supported the sales. So page 8, municipal assessment and search. Page 9, you can see the interior picture of the building. It's a good quality building. You can see in a page 10, they have laundry in suite laundry, and page 13 you can see the more pictures, and this is a kind of modern apartment, and you can see the page 15, they have EV chargers too. So, and page 16, you can say income and expense information up to page 21, page 22, and page 23, you can see their net operating income supported our net operating income. Model net operating income is 590,157, and the model, that's the model in net operating income. The actual net operating income is 588,925, and based on those evidence, I believe 12,830,000 is fair value for the property. This is concludes my presentation. Thank you.
Okay, questions, Mr. DuPont?
Again, to the questionnaire indicates that their actual rents are about 100,000 less than your rent. So did you look into that, or as to whether you would accept those rents?
Yeah, I mean, we are going with a model rent for this one. So that means the comparable support the model rent. Because of that, I believe model rent is good for the property.
Thank you. That's all questions.
Okay, Ms. Nesbitt, any questions?
No questions, thank you.
Ms. Schultz?
No questions, thank you.
Okay, Henry, you can proceed then. Sorry, Mr. DuPont.
I don't mind, Henry.
Mm,
Okay, page page 11, we come up with a cap rate 5%. Then page 12, we calculate the taxes. Now our taxes is lower than they show in the financials. So I double checked that, and as far as I can see there, we did that properly. So the page 12, it shows we use an assessment of 10,647,000 times the mill rate after rebate 21.477. And if we go to the next page, our spreadsheet line 13, page 13, so our line 30, the client shows 128,000 in taxes. We stabilize at 105 based on our calculations. Now the line 11, the owner does show a rebate as income of 4369. But if you take our tax 105 and the rebate, it would have been 110. So I'm not sure why the taxes were shown in 128. Nevertheless, I did not use the actual taxes. I used much lower than the actual. So if we start on top, potential rents, they're shown at 984. They're giving discounts 87. Vacancy is still quite high, 17%. So we used those line 3. We stabilized at the actual rents after discount 896 versus the assessor 983. We use 5% vacancy, mainly because 17% are still on lease up. We add parking. We don't have the realty tax refund as income because we are calculating tax below it after refund. So line 13, we're at 902 and the assessor's 948. So we have lower EGI than the city. The expenses, we stabilize at the first year operating, 5% management, and the repair maintenance, line 27, is relatively low at 813, and over time that should be going up. So our expenses is 401. So we have lower expenses than the actual shown. Part of it, the fact that we have lower taxes and lower management. No, that's not it. That's the advertising, line 19. The actual advertising 65,000. We brought it down to 5,000 because that would be high advertising for Lisa. So our expense ratio, line 32, at 44.5%. NOI is 501,000 versus the assessor 590, and we apply a 5% cap rate, so we get 10,022 is value. The questionnaires, page 17, it shows the potential rent there, 984,600. And then the page 18, they have the detail, the revenue and expense, and it shows the 984 with the discounts, etc. And the taxes are in the middle of that page, right under the W and S, 128,000. And they have a realty tax appeals, only $500. So it's not higher because they're adding appeal fees or anything like that. So I don't know why it's higher, but that's what they declare. But we use lower taxes. And page 20 is the board revision decision. They actually confirmed the assessment at 10,647,000 for 2022. And that's the amount we use for calculation of the taxes. And then we have the amenities and all that. So that would be my report.
All right. Questions, Mr. Assessor?
No question this time. Thank you.
Okay. Ms. Schultz,
No questions, thank you.
Ms. Nesbitt.
No questions, thank you.
Okay. I just question here. It seems to be the 1 year statement that we have. The gross rents seem to be pretty comparable to the city. Where the difference arises is in discounts and in vacancy. Would this not be indicative of the property, a new property leasing up? And would a potential buyer look at the long term, what he could be getting for rents after the discounts and have ended, and you're back to market vacancy?
You probably are aware that most of the properties that were here today or in the past, they have discounts. Discounts is not just for lease up. That's many properties, even the older properties built 20, 30 years ago, still have discounts. So that's the market that it has at the time. That's the discounts they're getting. It was built 2021, so this is the second year of operation. So there's no evidence that they can get higher rents in the future. So we normally accept the actual discounts the property has. And it's just speculation as to whether they can get higher rent in the future or not. Quite often, after 5-6 years, they still have a lot of discounts, and quite often they have similar rents that they had in the first year. So that I don't think it's proper to just project that they would get higher rents. And the vacancy at 17%, for sure, that's because of lease up. But if somebody's buying at the time and you're taking property, it's over 17%, you're going to lose money as a purchaser, and you would allow higher than normal vacancy. So 5% is what I use there, and so it's not that far off from the assessor.
Okay, thank you for that. We will go to next property, 1639 St. Mary's. Let me open the files. Okay, Mr. Assessor, on 1639 St. Mary's Road, you can begin.
Thank you, Mr. Chair. File number 24-2957, roll number 0808 1222 130, 1639 St. Mary's Road, roll year 2025. Reference date April 1st, 2023. Assessed value 17,223,000. Classification 20 residential. Liability taxable. Number of building 1. This is a 4-story building. Actual build year 2020. Number of suites 66. Outdoor parking 100. Page 2. You can see request for income information. And page 2 also you can see subject sales history. Page 3 you can see the location. This is a good location, I can say. And page 4 you can see income value summary. Average rent per unit 1,705. Gross potential rent 1,350,946. Vacancy rate 3.6. Effective gross income 1,302,312. Expense ratio 37.18. Net operating income comes at 818,112. We have used 4.75 capitalization rate. Estimated market value comes at 17,223,000. Market value per suite 260,000. Sorry, 260,954. Rent comparable. You can see rent comparable in page 5. You can see subject model rent, subjects property model rent supported by the market rent. And page 6, you can see the capitalization rate. Those are model generated capitalization rate. And page 7, capitalization rate evidence. The following is the sample of the actual sales that took place during the reference.
Okay, with regard to this page, we've gone over it several times, so I don't think it needs to be
Sure.
read verbatim again.
I got it. Yeah, you can. This is familiar page, so
Yeah.
I'll pass that one. And then page 8, Municipal Assessment Act excerpt, and uh, in page 9, as I mentioned, this is the purpose of showing our assessment is in line with the market sales. So. That's the purpose of page 9. And page 10, you can see the exterior and interior of the building. This is good quality building, and it's a new building anyway. So page 12, 13, and 14, you can see income and expense information. Page 16, I have to mention in page 16, if you go into the page 16, they don't have insurance in actual the um, income and expense information. So it's in the bottom of the page. So insurance, and so page 17, 19, up to page 23, income and expense information, and page 24, I have done the stabilization. This is the to show the purpose of doing this, to show the if we use their actual what's going to happen. So it's appear still income is low and expenses too high. So when I'm using utilize that NOI, like if so, basically we can't get actual the cost of the building. So basically that's the purpose of showing that. I believe this 17,223,000 is in line with the market sales. So I believe this is the fair value of the property. This is conclude my presentation. Thank you.
Okay. Questions, Mr. DuPont?
So your page 24, when you do the actuals, you come to a value of 11 million versus your value of 17 million. So doesn't that indicate maybe you should be adjusting downwards your value?
And no, because if you are comparing the just the cost of construction of the building, it's 12,500,000. So any buyer would buy that in this one for like more than that. Because of that, I am not agree with that. Thank you.
That's all questions I have.
Okay, Ms. Nesbitt, questions?
No questions, thank you.
Ms. Schultz?
No questions, thank you.
Okay, and the cap rate on this one is 4.75 versus 4.6 on the previous property, which were both built in the same year. Is it strictly size that's causing that difference? They seem to
Yeah,
be pretty comparable. One's 57 and one's 66 suites.
yeah. This is model generated, and I believe the size act there, because if you are looking at the page 7, like in our cap rate, small size apartment have like, but I can't exactly say that one because also the age of construction have effect on the cap rate, right? So I believe size in here, as per your question, the size is the matter here.
Okay. Mr. DuPont, you can give your presentation now then.
Yes, I guess you can skip to page 12. It showed that we had a cap rate there, 5.25, and that's a typo. I changed it to 5%. So the next page, we have a cap rate at 5%, page 13. So the potential gross rent line 1 is 2021, 1,106,000, and went up to 1,209, and down to remarks is 2023, 1,221. So they barely moved after. And the discounts were relatively low. So line 3's potential that they have was 1,000,002, and that's we stabilized at. The vacancy was still high, 10.3. We stabilized at 5%. And then we added parking, line 10, and miscellaneous income. Now, maybe we should do an average there because it was some 96 the year before, but nevertheless, we took the high and miscellaneous. So line 13, we're at 1,191,000, and the assessor 1,302. So that's a big difference we have there. And the rents. And so they start off with lower rents than the city has. Now the expenses, line 31, they have actual expenses 577,000 1 year, and the assessor had 484. I should have went maybe somewhere in between, but I chose to use the assessor's expense ratio 37.2. And I think I probably should have gone at 40% expense ratio. But nevertheless, that's my report's at 37.2. So line 33, our NOI is 748 versus the assessor's 818 versus the actual 546. So I'm probably too low in expenses. And I guess if I appeal further, we'd be looking at increasing the expense ratio. But for today, we're using that NOI and a cap rate of 5% to get a value of 14,972,000. And that's our report.
Okay. Any questions, Mr. Assessor?
No question. Thank you.
Okay, Ms. Schultz,
No questions, thank you.
Ms. Nesbitt.
No questions. Thank you very much.
Okay, we will move again further north to 1106 St. Mary's. Again, I forgot to open the files. If you give me a moment. Okay, 1106 St. Mary's. You can begin, Mr. Assessor.
Thank you, Mr. Chair. File number 24-2837, roll number 080040120000, 1106 St. Mary's Road, roll year 2025, reference date April 1st, 2023, assess value 10,534,000, classification residential 2, liability taxable. Number of buildings 2, number of stories 9, actual build year 1968, and number of suites 68, indoor parking 25, outdoor parking 41. And you can see in page 2, request for income information and no sales history for the subject property. And page 3, you can see the income value summary. Average monthly rent per unit 1,334. Gross potential rent comes at 1,088,666. Vacancy rate 3.6. Effective gross income 1,049,474. Expense ratio 44.29. Net operating income comes at 584,662. We have used 5.55 capitalization rate. The estimated market value comes at 10,534,000. Market value for suite 154,911. You can see the rent comparable. The subject property rent as the subject property model rent supported by rent comparable. And page 5, you can see the location of the building. It's in a good location. And page 6, capitalization rate evidence. These are model generated capitalization rate. And page 7, you can see the sales supported by the our capitalization rate. So page 8, municipal assessment excerpt. Page 9, you can see the exterior and interior of the picture of the building, and it's in a average good quality building. So page 7, I have done the stabilization. In here, you can see their repair and maintenance are so high, and also their vacancy is too high. So normally, if vacancy high and repair and maintenance high means they are doing some renovation. That's what we notice normally when we are looking at the income and expense information for the properties. Because of that, I have used $200 dollar per unit income and expense, repair and maintenance, but $200 per unit means it's in a higher side. But anyway, I use that, and I use market expense, vacancy to calculate the stabilized net operating income. So that's not the value is supported our model generated value. So page 14, 15, 16, 17, 18, up to 19, it's income and expense information. I just found the all permit. That's all the information I found about the permits. So based on the evidence, I believe the assessed value for 10,534,000 is fair value for the property. This is conclude my presentation. Thank you.
Questions, Mr. DuPont?
Yes, your repair and maintenance, you did not analyze any of the repair and maintenance. You simply took a round figure, 2,000 per suite.
Because normally, like as my experience, we are entering income and expense mailer for each and every property every year. So this 200 per unit normally higher end of the expense and repair and maintenance. So that's why I use $200 per unit.
Yeah, so I'm still on your page 13. And then the vacancy, you use 3.6, but you have a full 3 years, 6.6, 5.25, 5.53. The average is 5.8. You stated because they're doing renovation, but this over 3 years is not just because the rents are high and they're pushing the rents and the market is pushing back.
Because normally the vacancy and the repair and maintenance have link. So that's why I believe this is I'm not sure what they are doing, because it could be the poor management. If they are doing a poor management, do we need to discount their assessment? No, because if we are market this apartment, the buyer will buy, and they do the proper management, and they do the they perform well. So yeah, that's the answer for that question.
This is managed by Globe General. They've been doing apartment blocks for managing and owning for over probably 50 years.
Yeah, like
Are you saying that's poor management?
I can't exactly say, but we noticed something in Globe. They are using very higher expense ratio than others. I don't know why. Like we can compare their uh, uh, information to other management company. That's what we noticed. So yeah, I can't answer that question. I mean, yeah.
No, so would you agree that Globe General has maybe higher repair and maintenance than some others, mainly because they're getting higher rents?
I'm not sure about that.
That's all questions I have.
Okay, Ms. Nesbitt, questions?
I have no questions. Thank you.
Ms. Schultz?
No questions, thank you.
Okay, you can begin, Henry, or Mr. DuPont.
The property is built 1968. So if you look on our page 11, our cap rate for 1968 is 5 3/4 to 6.5. We apply 5 3/4 cap rate. The assessor's income approach on page 13 is very, very similar to ours, except for vacancy and repair and maintenance. So that's our main differences. On page 12, if you look at the vacancy line 4, it's actual 57,133, and it's 5.5%. And we stabilize at 57,133. We state it's 5.8% vacancy, but that's a typo. It should actually be 5.5. We had initially stabilized the 5-year average and 3-year average, and I changed the dollar amount, but the vacancy amount did not change automatically. So we did stabilize at 5.5, the actual, which has led the rest of the expenses. It's very similar to what the assessor did on this page 13. The repair and maintenance, we stabilized at 2308 based on the individual. And I forgot to include the second page of our income approach, which is the repair and maintenance analysis. The evidence on the actual repair and maintenance we get from general ledgers. Now I can send that to the board now by email. I have it ready. I can send it to you if you allow me.
Okay, that would be new evidence. Mr. Assessor, how do you feel about accepting new evidence? Oh, you're muted. Okay.
So I'm kind of new to the board, but I'm not new to the department. But so I am not sure about that. Normally, we can't provide additional evidence after submitting the document. So I believe, as I know, we can't accept it.
Okay. So you object to receiving it. Uh, um, uh, okay, I guess uh, does the panel have any questions to Mr. DuPont on accepting new evidence? Ms. Nesbitt?
Is this perhaps something we should discuss in camera, Mr.
Well,
Chair?
we should. I just wanted to know. We will go in camera, but I just wanted to know if you had any questions of Mr. DuPont beforehand.
No.
I would. I never said it was new evidence. It's an analysis, and the board has accepted revised analysis in the past. This is an analysis of the repair and maintenance. So I guess you have to rule whether it is in fact new evidence, but it's not as if I'm giving you statements, etc. I'm just giving an analysis.
Okay, but still evidence that wasn't included in your package. That's the point.
That's correct. It's so it's that point. It's not in the original package, but it is an analysis and not truly new evidence.
Okay, Ms. Schultz, do you have any questions of Mr. DuPont?
No, I do not at this time.
Okay, then I guess we have to go in camera to discuss whether we are willing to accept this new evidence then. So we'll take a brief break for the panel to discuss this.
I'll just put the assessor, you have to continue.
All right, welcome back. The board has discussed this, and we've looked through the financial statements, and the financial statements just include lump sums for maintenance and decorating, and no breakdown on what those are. So we regard any breakdown as being new evidence. And we're, since the city has objected as well, we're not going to admit new evidence. But you can certainly speak, Mr. DuPont, to how you stabilize the maintenance, repair and maintenance.
Okay, so I will do that now. The repair and maintenance that we show, I guess on line 27, 245, 232, 265, and then we stabilize 156. We stabilize at about 100,000 less than actual. So for the general building, we went at 50% of the actual cost. The flooring replacement was $493 per suite, which is just below our $500 maximum what we have. So it appears that the $500 is based on the replacement flooring every 8 years. So Globe is quite good at replacing carpets or flooring. Appliance replacement, we went at 63% of actual to bring it down to our maximum 225. So they tend to do a lot more work on vacant suites upon turnover than maybe other managers. Basically, it's one way to obtain their higher rents is that they update those flooring and appliances upon turnover. The painting also, we brought it down to the maximum 225. Counters and cupboards, we also we went to 268 per suite, which is less than the maximum of 200. We excluded a couple of high years. We excluded 1 high year of electrical. We excluded 2 high years of plumbing. We excluded 1 high year of HVAC. And we excluded 1 high year of pest control. So that's part of their management is that the word they use to me is that we want beautiful suites to rent out. So they update their suites and they do more painting, I think, than most other managers because their painting tends to be at the maximum or higher than maximum. So they tend to repaint the suite upon turnover. So this is directly related to the rents that they're getting, so that we're getting back to our income approach page, line 3. They're getting $1,273 per suite for a property built 1968. So they're getting high rents. And in order to get those high rents, you need to match it with the high repair maintenance that they're getting. And I've disallowed a whole bunch of the expenses and I maxed out a whole bunch of their expenses also, like flooring, appliances, and painting. So I believe the repair maintenance is reasonable, 2308. So line 33, we have NOI of 529 versus the assessor 585 or so. And then they use 5.55 cap rate. We use 5.75. So we have a dispute NOI, about 50,000 difference. And our value is 9,201,000. Thank you.
Okay, questions, Mr. Assessor?
Yeah, one question. Mr. Dupont, don't you think they are trying to keep their income in kind of stable manner, and they are doing renovation few suites every year, and then they are keep doing that because of that they have higher vacancy and higher maintain cost?
Yeah, they're related. Yeah, they're putting the high repair maintenance in order to obtain those rents, and they push the rents, and they don't mind getting a bit more than their normal 2.6% vacancy. They're testing the market, so they have the highest rent that they can get, and they average 5.8% vacancy. So believe, and the case of this property and a lot of the Globe properties, we have to accept the vacancy they get because they're pushing the rents so high.
Yeah, then I have another question, right? So that means that's not in a normal operation in a normal apartment. So basically, that's have higher vacancy. So because of that, can we use their higher vacancy as market vacancy?
If you're using the higher rents, yeah, you have to.
Not rent. I'm asking about the vacancy, because you use higher vacancy, right? So I use market vacancy. Can we use their actual vacancy as a vacancy for that purpose to find the value?
Because they have higher rents. 1273 per suite is a high rent for 1968 building, and so the vacancy must be stabilized in relation to the amount of rent they're getting, and then the repair maintenance should be stabilized in relation to the fact that they're getting high rent. So if they had high repair maintenance but low rents, we could assume that perhaps it'd be increasing the rents in the future, but in their case, they're doing this on a recurring basis. So that's their style of management. They're pushing the rents to the maximum. They get some higher vacancy because of that. So I believe we have to use the actual vacancy.
Thank you. That's all my question.
Okay, Ms. Schultz, any questions?
No questions, thank you.
Ms. Nesbitt?
Thank you. No questions.
Okay. Let's push on then to 909 St. Mary's Road. I will open the files first of all. Okay. So, Mr. Assessor, you can begin on 909 St. Mary's Road.
Thank you, Mr. Chair. File number 24-2565, roll number 0800254400, address 909 St. Mary's Road, roll year 2025, reference date April 1st, 2023. Sorry, assessed value 1,325,000. Classification 20 residential, liability taxable. Number of buildings 2, number of stories 2 to 3. Actual build year 1995 to 2016. Number of suites 7, outdoor parking 7, and in page 2, you can see the request for income information. They didn't submit the income information regularly, but anyway, they submit the income and expense information in 2022. So page 3, and also you can see the subject sales history in the page 2. Page 3, you can see the location. It's in a good location. Page 4, income value summary, average monthly rent per unit 1,371, gross potential rent 115,213, vacancy rate 3.6, effective gross income comes at 111,065, expense ratio 43.35, net operating income comes at 62,918, capitalization rate 4.75, estimated market value comes at 1,325,000, market value per suite 189,285. You can see the rent comparable in page 5. Model rent supported by rent comparables. So page 6, you can see the capitalization rate. I'm not going to read the whole thing. Page 7, capitalization rate evidence. And page 8, municipal assessment at exert. Page 9, you can see exterior and interior of the building. It's a good average, good quality building. So page 13, I just show you the income and expense information there, but it had missing information, some information missing. We have accept the information, but we are not going to use for the analyze or enter into the our model because it's not complete information there. So yeah, page up to 19, income and expense information. Yeah, based on we don't have much reliable information to rely on for actual. So based on that, I believe market information help to value this building. So 2025 assessed value of 1,325,000, 1,325,000. I believe this is the fair value of for the property. This is conclude my presentation. Thank you.
Okay, questions, Mr. Dupont?
You show the actual rent received, but you don't use it. You're using higher than actual rents.
Because if you see their income and expense submission, there are a lot of missing information. So because of that, I can't rely on those informations.
And you say at the beginning the built 1955 and 2016.
Yeah,
So,
sorry, go ahead.
Yeah, so it appears it was an old building. So how many suites was there before?
Actually, I can find out it, but I don't have that information on my hand right now.
Anyway, so they renovated part of it and they added a few suites. So the photos that you have,
That's right.
You obtained that from their website?
Yeah, exactly. From the website.
And then the photo, page 12, So they have the washer dryer separate in a separate room. They don't have it on ensuite like most of the newer apartment blocks. Is that correct?
Uh, I can't exactly answer the question because I didn't inspect the property, and also this picture don't give right clue about that.
They don't what?
The clue we can see like this is look
Oh,
like a room, right? So I can't exactly say this is in a basement or in suite. So
it has a hot water tank there in that photo also. So that would not be in the suites.
sometime I have when I am inspecting, I have seen small um, uh, boiler, the hot water tanks inside the some apartment, but I can't exactly say this is in a basement or not.
Okay, that's all questions.
Okay, Ms. Schultz, any questions?
No questions, thank you.
Ms. Nesbitt?
Thank you. I may have missed the discussion on this, for which I apologize. But Mr. Assessor, on your page 13, you don't have any information for 2020 or 2021. Is there a reason for that?
Because they didn't submit it.
They didn't submit it.
No, you can see in the page 2.
Okay,
They
did miss it then.
no, no, it's okay. Yeah. So they just submit after 2018. They just submit the just information in 2022. But those information, I can say we can't use those information because a lot of lines are empty and they didn't put there's no total, nothing there.
Okay, and I think you indicated that for the 2022, it's also incomplete. Is that correct?
Yes.
But they did on your page 14 indicated their gross income at $114,000. Okay, thank you. I have no additional questions.
Okay, I was just going to ask about that too on page 14. They indicate 7 suites and monthly rent of $1357.50. Is that what they're actually getting? Do you know, or is it, you can't tell from the financial statements?
They didn't submit the rent roll. So basically, I think they electronically submit this information, and so just they enter into the system and submit it. So I can't exactly say this is. I mean, they've finalized the submission, but I can't exactly say this is what they are getting because we can't see the rent roll.
Well, isn't there a rent roll on page 17?
Oh, sorry. Oh,
But
yeah.
it
Yeah, I
only
missed
covers
that.
6 suites. I don't know what happened to the 7th, but
Oh, yeah. No, I'm sorry. I missed that. So I mixed it with the other property in my mind. So sorry about that. Yeah, I miss. Yeah, this is the rent roll.
yeah, but there's one suite that's missing, and one suite seems to be very high, and the other suite seems to be low.
I will accept the assessor's rent view of that because they're page 14. They show 114,000 potential rents, and the assessor's got 115. So it appears that. So my submission I had used 97,000, but it appears that they had one suite missing, as you say. So I will
Yeah.
change my evaluation. I'll agree to their rents and I'll agree to their expenses. So I dispute cap rate only now.
Okay. All right. Okay. Thank you, Mr. Assessor. Is there anything you wish to add to your after that?
No submission. Thank you.
Okay. So Mr. Dupont, then you can begin your, I guess only on cap rate now.
Yeah, it's only on cap rate. Yeah, so my page 12, we're saying it's 1994, we're a variant, but the part was built 1955 and 2016. So they have an old base from 1955. So our cap rate's 1990 to 2004. We started 5.25 to 6. So we give it a cap rate 5.25, which one match its age. And so now I have to do some page 13. I was using the rents from the questionnaire, but I now changed it. So I'll give you a new value.
1,198,000.
Okay. 62918 divided 0.0525. Yeah, 1,198,000.
Okay. Any questions, Mr. Assessor?
No question. Thank you.
Okay, Ms. Schultz, any questions?
No question. Thank you.
Ms. Nesbitt, any questions?
I have no questions. Thank you.
All right. And we come to our last property, which I understand Mr. DuPont will be requesting confirmation. So it's 738 St. Mary's. So, Mr. Assessor, if you can just briefly lead us through your presentation.
Okay. File number. Thank you, Mr. Chair. File number 24-1717. Roll number 0800150400. Roll year 2025. Reference date April 1st, 2023. Assessed value 1,715,000. I'm not going to go for each and every detail. This is a 1959 building. We have effective age 1974, 16 unit, 7 outdoor parking. You can see the request for income and expense information, and subject sale have subject property have newer sales. It's April 4, 2022, 1,800,000. And so you can see our income value summary. Net operating income 80,622. We have used the 4.7 capitalization rate. Estimated value comes at 1,715,000. And you can see the comparable, page 4. The comparable support our model rent. You can see capitalization rate and municipal assessment at excerpt in page 6. Page 7, I add their sales information. And page 8, there's a pictures, and page 9, what they are listing on the income about the listing. Page 10 also how they listing in the listing for the sales. Those information in up to 11 and 15 to 17. Page 18, you can see, actually, I have to correct the address and roll number. It should be 738 St. Mary's Road. I apologize for that, and it should be corrected. And page 18, stabilization. If I use actual sales information, how that value comes, you can see in the bottom, and there are stabilization. you can see how they reported to us and how they reported to the public. I mean, advertised to the public. That's why we don't use most of time what they are reported to the sales. So we every time stabilize 3-year income, but anyway, they are reporting low income and expense to us. If you are comparing 2021 information to the sale information, you can see. And so this is the income and expense information, what they submitted to us up to page 28. So based on those information, I would like to ask to confirm the value of 1,715,000 for this property. Thank you.
Okay. Henry, Mr. DuPont, do you have any questions?
No questions.
Okay, Ms. Nesbitt, any questions?
No questions, thank you.
Ms. Schultz, any questions?
No questions.
Okay. Now, Henry, understanding your question, confirmation on this?
Yes, I saw the sale price, and therefore, based on the sale price, there's no case. I also mentioned that the assessor cannot ask for an increase unless he files a 10-day notice, and that was not filed. So I asked for confirmation, and I will likely get the client's response to not appeal further once we get the decision, so that the appeal will die.
Okay. Thank you, Mr. Assessor. Any questions on that?
No question.
Okay. Thank you. Now then, we've heard all the properties on today's agenda, and this hearing is now adjourned. So, gentlemen, thank you very much for your capable presentations once again.
Thank you, everyone. Have a
Thank
good
you.
day. Bye.
Okay. Now the panel will just take a brief break, and then we'll come back and do our deliberations.
What time do you want to
Thank
start?
you.
Oh,